Happy New Year and welcome to the WARR Hunt Quarterly Market Update to 31 December 2022. Well, it's been certainly an interesting period, or the last 12 months have certainly been an interesting period with lots of volatility, markets moving up and down, lots of talk of inflation, interest rates heading up, bonds coming off, markets jumping around all over the place. We saw a bit of a rally towards the end of the quarter, which then sort of came off. Steve, what's happening out there? How would you sort of sum up the last 12 months and in particular, say the last quarter?
Yeah, well, you summed it up pretty well about the volatility, Sam, but you're also right, in the last quarter, and this might surprise many people because you really only hear about bad news in the media, it was actually a very strong quarter in Australia, market up by 9.4%. You can see in the chart here, even the US up by 7.4%. But when we look at the longer time frame, Australia just down by minus 1.1%, but the US market, the biggest equity market in the world, that's down by a big 18%.
What sort of drove that return for Australia? It seems that the US heavily exposed to things like tech stocks. They've really come off, but resources have gone pretty hard over the last quarter in Australia.
Once again, Sam, Australia market's been saved by resources. Resources in Australia are about 25% of the Australian market, and they've done really well over the year and over the quarter. So not only has that propped up the quarterly rally you see, but more importantly, it's propped up the over the year rally. And you're right, Sam, over in the US, a big part of their market is in those big high tech stocks. And the NASDAQ index, which kind of represents those big tech stocks, that's down by a whopping 33% for the year. So that's really brought down that US market.
So Steve, that's a good sort of context for Australia and probably the NASDAQ, but what's happening more broadly in, say, global markets?
Yeah, so if you look at our chart here, Sam, which shows the different markets, first of all, the rally we talked about in the last quarter, you'll see that exists in all markets. In the developed markets, again, the US is the biggest part of the developed markets, and the emerging markets, they're both up around 4% for the quarter. When we look at the year, though, we'll see that the developed markets are down, mainly led by the US, and the emerging markets are down too. They're mainly led by China. China's down about 20% for the year, and that's the biggest part of the emerging markets.
Before we sort of jump into the factors of return, it might just be worth doing a quick recap on our philosophy. I mean, ultimately, we're taking a very diversified approach when we're investing clients' monies or setting up their portfolios, and depending on your stage or your risk profile, how you're skewed towards equities and the defensive component within cash and fixed interest. But when we're talking about equity returns, we're really trying to target the return from value type stocks as opposed to growth, and skewing towards smaller companies as opposed to large. How have those premiums panned out both in the Australian context and internationally?
Well, Sam, this is sort of a consequence where we talked about the big tech stocks really having the biggest fall of any asset class. They are the growth stocks, and what's that meant? There's been this huge value premium both in Australia and globally in the last 12 months. It's been one of the biggest value premiums we've seen for ages, and that's really helped the WARR Hunt portfolios having that value premium. Now, on the other side is that small caps have not done that well, particularly here in Australia. Small caps really do tend to get whacked when things are volatile. Globally, small caps have performed in line with the overall market, but here in Australia, small caps are down a long way. So they're the two premiums. Premiums are quite volatile, Sam, but we certainly do expect that over the longer term that those value stocks do better than growth stocks, and that small caps do better than large cap stocks.
Yeah, and talks to the point really about the importance of diversification. One is having exposure to equities, both Australia and internationally, but then having exposure to those various premiums, so large, small, value and growth in the context of a portfolio, because you really don't know when each of those premiums may perform. So whilst we've had an exceptional period with value, small has underperformed over that same time. So Steve, fixed interest is sort of the defensive component of clients' portfolios, and that's probably seen the most volatility ever really in the last 12 months, and particularly the worst 12-month return to the end of December. What's really driving that? What's the expectations for the future for fixed interest?
So when yields go up, bond prices go down. You can see in the chart here that over the year, those 10-year bond yields have been driven up by, of course, the rising interest rates, which again are a consequence of rising inflation. Now, in that chart, you can see the returns of the Australian bond index, and you can see the returns have been negative for the first 3 quarters, really badly negative. But you can also see that rally that we talked about in equities. Mm-hmm. That happened in bonds as well. So this is small relief, but there's a positive quarter for both Australian bonds and global bonds.
So probably to put the return in context, I mean, the last time we had a negative return in both equity markets and bond markets was with 1993, 94. So this is the first time we've seen it in many, many years. What's sort of the expectations kind of going forward with fixed interest? There is talk about trying to hit this terminal rate, which defined as the long-term cash rate, and that's really, at the moment, there's a lot of uncertainty as to where central banks will land with that cash rate. But once that terminal rate's been hit, would you expect the volatility in bonds to settle down again?
Yeah, that's absolutely right. The terminal rate, Sam, we don't exactly know what it will be, but it's not far away. So in Australia, most economists are predicting 3.6, 3.85% maybe. In the US, maybe as high as 5%. That means there's a few more rate rises to come this year, but not many. And you're absolutely right. Once we hit that terminal rate, then you expect that bonds to get much less volatile. Now, ahead of us, though, is because of those high terminal rate, it's widely assumed that global economies will slow down. In fact, that's not much of a prediction. I think we can expect a slowing economy. Then you will expect later this year or next year, rates will start to come down again as central banks need to get the economies moving again. So bonds, while it's been a really tough 2022, then I think we can expect that going forward, bonds will be earning 4 or 5%, just if they don't move at all. Mm-hmm. And if the rates start coming off, then you can expect capital appreciation out of those bonds as well.
Yeah, so I mean, really it's quite a sharp instrument, moving interest rates. You would expect the economy to slow down by the mere fact that interest rates are on the way up. So it is quite a powerful tool and can work in the reverse too. That if things slow down too much, central banks then have the capacity to cut again to stimulate growth.
There's actually room to move now for central banks to actually lower rates a little bit to get the economy moving.
Yep. So to sort of sum up, certainly the last 12 months to the end of December have been quite volatile, and we could be moving into further volatility for the next 12 months. Those things are unknown, but what we do know is that we do expect periods of volatility when we're constructing portfolios. So we don't know when these periods will arise, but we do expect that they will happen at a point in time. So really now is not the time to make changes to the portfolio. If there's been changes within your life or into your goals and objective, that's when it's time to really revisit those and make changes as appropriate. So thank you for joining us today, and we look forward to catching up at the next quarterly review.